Stock market's certainly been volatile this year. Should you continue to invest in your 401k during bear markets, or should you pause your 401k investments during a bear market? I've got research and insight on that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. This is a fantastic question. Saw an article recently that asked this question, and I'm a financial geek, so I know the answer, but it was nice to look at the data. You've wondered this. I'm assuming you have, and if not you, then you're a rarity, and that is, during a bear market, should you pause your 401k contributions? Should you just put a hold on your 401k contributions just until, the clouds blow over and things get a little bit calmer? I think we're all tempted to do that, and it goes back to just our very own kind of nature, our simple nature, and that is, you invest, let's say, $1,000 in your 401k this month. And then you get your 401k statement, or you pull it up online at the end of the month, and you look and you've lost $2,000 for the month. And you think, oh my goodness, I just threw that money away. Had I not saved that $1,000 and just kept it in my paycheck and had it go into my bank account, I would have an extra $1,000. Instead, I put it in there and it's gone. I lost it. And if you're looking at your bank account or your savings accounts, that's true, actually. If you look and at the beginning of the month, the balance is this, and at the end of the month, the balance is this, that money's gone. But with your 401k or your Roth IRA, your IRA, it's different because the money that you invest in is buying shares, and those shares are not gone. They are just repriced every day. In the case of exchange traded funds or stocks, they're priced, several times, every second during the trading day. But mutual funds, they're repriced. Those shares are repriced every single day. And so the value goes up and down. So the $1,000 that you put in, or those contributions, even if your account value goes down, those dollars aren't lost. The value's temporarily down, just like the value of your house would be down, whatever. So of course you're going to know that the research, just like I would tell you, and I've told you multiple times over the course of this year, stay investing, keep investing, keep investing, keep investing, even during volatile times. In fact, it's even more beneficial for you to keep investing during volatile times. But contributor at Morningstar actually just recently did the math to prove, is it helpful to pause your 401k contributions during bear markets, or should you continue to invest during bear markets? And she looked at the most recent 3 bear markets in challenging times, and that's 2000, which at the time, the tech bubble, that was the worst stock market since the Great Depression. And then she looked at the 2008 Great Financial Crisis, which was the worst the worst stock market since the Great Depression, surpassed the tech bubble. And then she looked at the COVID shutdown, which was the fastest and sharpest bear market that we'd seen, and then obviously followed by a fantastic recovery, the fastest, the best 50 days in the stock market ever. And so she looked at each of those, and I'll tell you, the results speak for themselves, but she really, really was generous in the assumption of the person that paused, okay? In one scenario, she looked and said someone's contributing $500 a month, and they just continue to do that even through all of the market downturn, through 2000, the tech bubble, through 2008, and through February and March of 2020. But the contrast is the person that paused, she essentially said, well, they paused, and she made 2 assumptions that I don't think would be accurate in real life. And one is, well, the person that pauses their savings continues to actually save that money, saves it just in the bank account. I think odds are, if you're not saving it into your 401k and it goes in your checking account, you probably just spend it. That's my guess. She's assuming that you still save it for the long term. That's one. But then the second one, I say there's no way. And that is, in each scenario, she essentially assumes that the person that pauses begins investing at the absolute bottom, which is, there's just no way that would happen. There's just no way that if you we're thinking, I gotta wait until this blows over. I'm gonna stop my 401k. There's no way that you start investing again until the market has recovered significantly, because you never know if the stock market's fully recovered or if it's safe to start investing until most of the goodness is gone. In fact, most of the goodness is already realized, I should say. And typically you're thinking, well, it's gonna drop again. Things, a lot of economic data is still bad, blah, blah, blah. And so you usually just wait. And in her scenario, in each of the scenarios, the person that pauses their 401ks essentially begins investing at about the worst time. And so these numbers, they tell a very clear story, but really in reality, played out in reality, the numbers would be far more extreme than what they show. All right, let's get into the data. Case number one, let's go back to the tech bubble. And this is one of the longest downturns in the stock market, 3 years of awful performance, 2000, 2001, 2002. That takes a lot of guts. And so for the person that was contributing $500 a month and just continued contributing $500 a month from January 2000 until right now, until October 2022, what would they end up with versus the person that stopped, that didn't save during or didn't invest in their 401k during January of 2000, but instead started in October of 2002. Comparing the difference there, significant difference. The person that continued saving has nearly $50,000 more accumulated by October of 2022, 22 years past all of this occurred, nearly $50,000 higher. And again, it would be much more extreme if the author here didn't assume some pretty generous assumptions for the person that paused. But very clear that the person that continued contributing is better off. And because of these scenarios, that person that paused can never catch up now, unless the person that continued contributing makes a mistake or something like that, but they can never catch up. So about $50,000 benefit to the person that continued to save. What about in 08? And again, guys, this is extremely generous. The person that saves $500 a month starting January of 08 and never stops, versus the person who says, I'm not going to invest in my 401k during all of 08, and I'll start in January of 09. I'm saying there's no way. If anyone in reality looked and said in January of 08, yeah, I don't think I want to invest. No one was thinking that. The tidal wave, we didn't fall off the cliff until September of 08. In January of 08, everyone just thought, well, this is a normal little downturn. Of course, things were getting hot, real estate bubble, blah, blah, blah. Things were a little hot. We're just, taking a little breather. No. So, and come January, there's no way you would begin investing in January of 09. There's just no way. If you thought, well, I got to wait for things to calm down, there's no way you would have started in January. But the author said, well, let's compare the two. Person that just invests into their 401k, $500 a month, starting in January of 08 and doesn't stop, versus the person who takes all of 08 off and just saves that money somewhere else and then begins investing in their 401k January of 09. Close here, but still not close. About a $20,000 difference between the person that is continuing to save during 08 versus the person that paused their 401k investments and saved somewhere else. Again, that person that paused their investments, they can't catch up. They won't be able to catch up now. A 10% increase, about $20,000 increase for the person, or benefit for the person that continued saving. All right, and then take a look at case 3. You're not going to spend a lot of time on this, and you might say, well, there's barely a difference here at all. And again, I would point out that the author assumes that, if comparing and contrasting someone that is saving $500 a month into their 401k starting 1/1 of 2020 versus someone that stopped contributing into their 401k just for February and March and then restarted right after the worst of it. Again, anyone that has that type of timing, that type of skill, should invest everyone's money, right? It's just not possible. But you can see even in that scenario, the person that continued to invest is slightly better than the person that just invested at the bottom. And okay, so why is that? Because the dollars that you're contributing, even during the worst times, the darkest times, are the ones that have the most growth potential. The person that started investing right after the worst of it never had the opportunity to buy at the very bottom, never had the opportunity to invest into the shares that were going to work the hardest for them, that were going to rebound the most. I've got another chart here from one of our all-star CFPs on the KFG team, Bill Mock, uses this one, and it shows $100 invested at any given time, or I think it's the past 15, 20 years or something like that, and what that $100 would be worth today. And guys, just take 08. If you look at the chart, it just stands out. The $100 that was invested in 08 is your hardest working dollars. They're worth, $450 or something today, or whatever. The dollars that are invested during the worst possible time, which you can't anticipate, you can't predict, those are the dollars that have the most upside potential, that are going to work the hardest for you. Therefore, it just underscores the point that you should, even as hard as it is, as emotionally confusing and difficult as it is, you should continue to invest in your 401k during bear markets, in your Roth IRA during bear markets. You should not pause. It just reminds me of a famous quote from Warren Buffett. The most important quality of an investor isn't their intellect, but rather their temperament, okay, or something to that degree. And again, that's just your patience, your endurance during difficult times to just continue to invest. Those are the ones. All of the research, it's very possible in the future we'll see something different, but all of the research in the past suggests that it's not even close. Continue to invest. Work with your certified financial planner. They're going to help you figure out how much to invest, what to invest in, and help encourage you during these challenging times to continue to take your wise step and contribute during these challenging times. So work with your CFP on that. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.